Hey, good morning, everybody, and thank you for jumping on the webinar with us this morning. So, my name's Trevor Froling, and I'm an insurance agent with CommonGround Insurance Group. I've been working with CommonGround for 4 different years now, and I'm very proud to present this private product that we actually partnered with Hudson Crop Insurance to create. So this policy is Cash Lease Insurance Protection, and the acronym of CLIP. It's kind of a catchy name, and we really like this policy. We're kind of biased because we were part of making it, but it also serves a very significant place in a growing season's risk management portfolio, right? So a great way to use this is when you can't commit bushels, right? When the risk is the highest, we can use this policy to protect from dropping prices. So what I'm going to do, I am not going to, I'm not a long-winded guy. I'm going to go through this. It'll take 15, 20 minutes to get through the guts of this deal to understand what it really is and the basics of it. The the particulars for each person, each county is a little different. So every individual that's interested in this, please reach out and I can individually quote it per person. But yeah, let's go ahead and get started. So to start off, what is CLIP? What is this private product? It's a non-federally reinsured supplemental product created by Hudson Crop. Now, all that means is it's a private product and it's not subsidized by the government. So you have your revenue protection. It is subsidized, right? They're paying for part of it, you're paying for part of it. This bill is 100% on the producer, on you guys. So whatever it costs, you're paying for all of it. Now, it allows a producer to elect a band of coverage to lock in a market price. So the way this works is every day you have December futures corn, November futures beans. You can lock in any given price during the day as long as the markets are open that day. I mean, if it's Martin Luther King Day or something like that, you can't buy it because the market isn't open. Now, Clip has a daily price offer that provides flexibility on a per farm basis. That you can get a higher guarantee outside of your federal crop insurance. So the issue with the RP was always, well, hey, I'm only getting that February that date, right? The average of February, that is not when prices are typically the highest. Now, the last 2 years, that may have been the case, but typically that's not what happens. Is we get into the summer, we get into planting season when there's problems, and that's where we get weather markets. So we can use CLIP outside of that federal crop window, March through July, to basically lock in a price outside of that federal crop date. Now, this can be purchased by farm lease, and unlike federal crop, can be purchased on a per farm basis. So, what another thing I really like about Clip is the amount of times I've met with producers, and they say, "Man, I farm on this side of the county, and then I farm on the other side, and I want this insurance on this side of the county, and on the bad half, I want the better insurance." Federal crop insurance won't let you split it up. Now, what this private product does is it'll let you do it by farm, by lease, right? So if you have a lease agreement on acres, you can buy this policy on it as much or as little as you want. Now, the price is based with no yield calculation factored in whatsoever. So revenue protection, you're taking yield times price and a percentage of that yield, betting against October and your actual yield on this policy. It is completely based on price. Yield is not a factor whatsoever. So for these producers that you overproduce every year, you're 20, 30 bushel ahead of your APH, you're thinking, what kind of insurance can I buy where I could actually have a chance to get some money back and limit some risk? Well, Clip is a good option for you because you're betting on price. It doesn't matter if your yields are really high, you can still collect on a payment. Now, it can be purchased or quoted daily from 8:45 in the morning to 12 o'clock Central Time. They're pretty strict on their dating on this. Any policy that's bought by a producer, the insurance company, the way that they protect themselves is they hedge it. They hedge their bets on these. So as soon as you bet one way, they bet the other way to limit their risk. This is they call this a no sum gain for the crop insurance company, right? They're not making a lot of money on this policy. insurance agents aren't making a lot of money on this policy. It was completely created as an add-on to help support farmers lock in, higher prices and take away some risk. It's like I said, they're hedging on their side, and the cost to do that basically, nixes out whatever the premium would be. So it's basically just an offering to help farmers. Now, what's the availability of this product? Right? We have a myriad of states up here: Nebraska, Iowa, Missouri, Wisconsin, Illinois. It's kind of case by case basis. I mean, if somebody's outside of these states, it's a private product. I could always, go to the insurance company and say, hey, this person wants that. These are the main states that us at Common Ground have written in so far, where it's the most relevant. Now, if you're outside of this, we can look at it too. But that's the main categories of areas we've covered. This provides coverage for a loss of revenue for any acres that are cash rented on a valid lease agreement. So as long as you have that lease agreement, I can base your acres, your liability off of that lease agreement. Now you cannot buy a liability limit higher than your total cash rent. So if you guys say to me, "Hey, listen, my cash rent is $200, but I want $300 of liability, is how much I want to get paid if the price drops." Well, no, they're going to cap you at whatever your cash rent limit is. So if you're paying $200, that's as much an acre as you can get back on a liability payment. Now, the other thing I like about this is you don't have to be all in or all out. You can do multiple price guarantee lock-in options. So like me, I don't know about you guys. I'm a big cost average person when it comes to selling my grain. I sell in small increments for better or worse. But you can do the same thing on Clip if you want to. Now you can do it all at once. But if you said, well, Trevor, I have $200 worth of liability. I want to do $50 in May and then another $50 in June. You're spreading out that liability and you're also getting different price limits, right? And you're every time you do a policy, you're betting on a different price cap that you're betting against. So it gives you different options and more availability that way. Now, what are some key dates on this? When is it relevant? So for me, the best time to buy Clip is typically in that May through July time period, those summer months. The closer we get to the end of July, the cheaper this policy gets. And the reason that is because you're betting against the fall price. You're betting against that average of December corn in October and November beans in November, just like on your RP insurance, right? Whatever number we lock in, 95% of that is where you start to get paid on the price. So earlier in the week, right, we had overnights. December corn got up to almost $5, 4.98. Well, if a person locked in, let's say 4.98, you're betting 95% of that against the fall price in October. So anything underneath that down to the end of your band, it would be a payment. Now, premium on this is billed just like your regular crop insurance. It's billed on 9/1. As long as you have a check in the mail by 9/30, there will be no interest on it. And then the deadline to actually pay on it is November 1st, and that would be with a little bit of interest. Now, what are the policy advantages of Clip? It allows for trigger coverage levels from 95 to 90%. Now, myself personally, what I've found works the best is the higher trigger coverage level. I would always rather have the ability to get paid back faster. I'm the same way on my federal crop insurance. I really push for 95% coverage because that trigger is the key to it because you get paid back faster, right? You could take your liability down. You're always better off with the higher end trigger because then you're in the money, right? So you can go 95 to 90 on the trigger. It provides for a floor cover down 80%. The widest band you could buy is 95 to 80% of the price. And what that means is I'll use an easy number, $5. So 95% of $5 is $4.75. At 475, if you locked in five during the summer, if the fall price is below 475, you're in the money. Now, if you went all the way down to 80%, all of a sudden the fall price has to be $4 before you max out that policy and get 100% of whatever number you pick. But that number, that floor, that 80% can go all the way up to 93%. So in this scenario, let's say you picked $5. So we had a 498 on December futures earlier in the week. 498 times 93% is the lowest on the floor. If you locked in that 498 at 463 fall price, harvest price, you max out the band. You get 100% indemnity. Pretty good deal. I mean, that's typically what I have done is I take highs in the summer, right, or numbers that I get excited about, and I can't commit a lot of bushels. I'll lock in 50 to $100 liability at a time. If the price drops 40, 50 cents between the price I picked and the fall, I'm getting, it's covering a very significant amount of my cash rent. That's how I look at it. Now, the losses begin paying as soon as the harvest price drops below that trigger and there's no yield component. So the claims on this are as simple as it gets. There's no adjusters. As soon as we get through the end of October, so that first week of November, checks get cut. So they know exactly what your price is, what your triggers are, and they know what that fall price is. Once that number comes in, there's nothing to wait on. There's no yields, no adjusters. It's me calling you saying it hit, we're sending you a check. That's as simple as it works. Now, on those liability payments, the interesting thing on this is you can actually have larger liability payments than the actual revenue with a high enough band coverage, right? So on your regular RP insurance, you might look at 85 RP, and depending on what your APH is, let's say your gross revenue is $800. Well, obviously, with this policy, you can guarantee 50, 100, to $300 worth of cash rent. Well, all of a sudden, you go to a bank, for example, and I've done a lot of this, and you say, well, my borrowing power is X, but when I buy this policy, I get this much more if the price drops this level. It gives a bank a lot of confidence in borrowing power, and I've done that probably 15 to 20 times so far, where I've went in, show this to the bank, explained how it works, and then I've had a borrower actually increase their borrowing power based on this policy, which is pretty cool. Now let's do some cash lease calculations. So how does this work? So the first thing we're going to do is we're going to determine the cash lease price, share, and number of acres. So easy math, 250 lease, 100% share. I have 100 acres, $25,000, right? Spring price is not applicable to cash lease. Liability is based on the elected coverage, acres, and share. To determine the band of coverage that the insured wishes to utilize, a tighter band equals higher cost, a higher trigger equals higher cost. So the most expensive version of this is the only version that I've bought personally, and it's usually the first thing I show to people I work with, is 95% trigger with a 93% bottom, which means at 93% of the price you pick, you get 100% of your liability limit, which I really like because, like I said, I like getting paid back faster. And at those levels, let's say $5 at 93%, I know at 465, I'm getting 100% of whatever liability limit I picked. And that makes me feel, confident going into a growing season. Now, the harvest price is determined, right? We have the end of October. Your calculation used to determine any indemnity. The premium is based on liability and amount of time until October. So the interesting thing about this policy, like I said, the longer you wait, the cheaper it gets. I'd say my sweet spot on this policy is that May 15th through July 15th timeframe, you can get about a 4-to-1 return on your money at that 95 to 93 coverage. So whatever number you imagine, you say, Trevor, this is how much money I want back if the price drops this much. It's about a 4-to-1 return on your money. So if you want $100, it might cost you $25 to get $100 back at 95%. Now there's cheaper versions. You can get that price down to $5, $10, but you're not going to get paid back as fast. And to me, the whole purpose of the policy is to cover a loss if the price drops. And I would rather see somebody have that higher band of coverage just so I know that they're getting paid back if there's a problem. Yeah. So why CLIP? Why do I think CLIP is relevant? So CLIP was created to be an easy way to lock in higher prices. This is something every one of us could do through our brokers. The problem is there's money up front. There's margin calls. It takes a lot of hands-on. I mean, you got to be looking at it almost every day. Me, I'm a busy guy. I run a hay business in the summer. I sell crop insurance. I'm farming. I got a 1.5-year-old. I want to buy something that I can do it, lock it in, know where I stand on it, and I don't have to look at it again. I don't have a bill until the fall. There's no money, there's no margin calls. I don't have to check on it every day, talk to my broker every other day. I can buy this and, sit there knowing what my guarantee is. So in an environment of volatile markets, I mean, I made this PowerPoint before the last week, but my goodness, I mean, I haven't. I mean, crude the other night got up to 120 on the open, and then it closed at 90, and now it's back in the 80s. So we're talking 50% market swings on some of these commodities in a day and a half. It's crazy. Um, and this allows farmers to take advantage of the volatile markets, right? The swings. And they're created by factors that make it hard to sell a crop. So, like me, it's extremely hard for me to sell a crop ahead. I try to get at least 30-40% by the end of summer sold. It's just really hard for me, especially right now, to sell a lot of grain ahead without even having it in the ground yet. I mean, you can. I mean, crop insurance gives you certain guarantees, right? It's just really hard to do that. Well, what Clip does is it lets you lock in that price without committing the bushels. So you said to me, well, man, I can't sell 50-60% of my crop. I'm not going to do it, but I can lock in that higher price. And if it goes against me, I'm going to get paid for it anyway. Now, with high return on investment expectations, Clip has given us a tool to protect against defaulting on cash rent payments. So I'm not unfamiliar to this. Cash rents, it seems like they only go up, right? And we all have, some of these cash rent agreements back in 2022, 2023, where we had to pay a premium then, right? The cost of entry on farmland is very big. So we all have a lot of risk. We can use this to subsidize our risk on cash rent, get potentially $100 to $200 back on our rent if the price drops, and then all of a sudden the math on our insurance, on our return on our money, it looks a lot better on paper when you have this backing you. Now, in 2026, I think there's a potential for a weather market. That's why I don't get too excited about booking bushels. I mean, right now I'm in Eastern Illinois. I'm just north of the University of Illinois. And if you looked at a drought monitor for the state of Illinois, there's a big red extreme drought circle. Our family shop is about right at the northeast tip of that circle. We're about the driest we've been that I can remember. I mean, 2012 comes to mind right away. I hate to even say it. I mean, that was the year I was a senior in high school, and we had our corn planted by the end of March. Um, but yeah, that was a pretty tough year. And I've had a lot of people tell me they're seeing similar weather activity to that year, and I really hope that's not the case. But no, I mean, if there is a weather market and we don't have the bushels to sell because we don't know what we're going to have, I mean, we go 2 weeks without rain and we don't know if it's coming. This is a policy that we can utilize because we're not locking in any bushels. We're just locking in the higher price, and we're doing it on let's say the high percentage of our cash rent, our highest cash rent in the ground. All of a sudden, if it does go against us on the clip and the price does go way up, 90% of your ground, you're winning because you got a higher cash price in the fall. You got to keep all your corn, your beans, and then you just pay the clip. It's a write-off, right? So when I buy clip, I'm praying to hell it don't pay, because if it pays, that means the market in the fall sucks. But if it does pay, it's helping me cover the difference. So it's kind of a win-win. You buy it, and if it pays, are we really winning? I mean, our cash price will be, 50 cents, 60 cents below what it is right now, if not more. So um, that's part of that. But why do another reason I think clip may make sense this year. So there's 3 prior years where we've had a spring guarantee. We had 591 and 23 on corn, 466 and 24, and 470 and 25. Right. So the last 3 years we've had pretty decent guarantees on crop insurance. Going in the fall, the last 2 years we've had over a, it's around, let's see, 50 cents in 24 drop from spring to fall. And then this last year, we had a 48-cent drop from spring to fall. And that's why a lot of these indemnities were paid. These fall prices the last few years have been pretty bad. I mean, even in 23, the fall price was 488. So we've had over a 10% drop from spring to fall in the last three seasons. Now, every year is different, but when you have that kind of risk, if you can use this to protect it, it's a good idea. Now, the lower the spring price, the better the clip could potentially look as we look to create a higher guarantee. We went into that a little bit. Could another great crop lead to $4 or sub $4 corn this fall? I don't know, maybe. I mean, this the all this activity in Iran, you'd surely not think so. But I saw that Trump came out and he said, "Hey, this deal in Iran's almost over. We're about done over there." Well, all of a sudden they get back out there and we're all back to business. Why wouldn't it go back to right where it was? Who's for me to say? If I believe one way or the other, I'd be buying a lot of options, right? Um, So a rally this summer with a weather event could give us the best opportunity to lock in that higher price. I still believe that, and there could be a lot of potential in that. Now, when will the clip pay and your federal crop not pay? So for easy math, you take a 200 APH grower. He buys 85% revenue protection per field. We lock in that 462 guarantee. That's our 26 crop insurance guarantee, right? That would be 170 bushel trigger yield on that 200 APH farm. You have your guarantee there of $785. So anything under 785, you're in the money on that RP policy. Now, using CLIP this summer, we get a bump in the market, right? Like we did here the other night. A producer locks in 490 on the board with 95% trigger and an 85% floor. So let's go through and see who wins. Now, we have the exact same scenario as the last 3 years. We have a drop of around 10 to 15% of that fall price. We have a 417 harvest price in October. Clip would pay full indemnity of whatever scenario we picked, right? If it was $100, $200, $300, it's maxing out at that 95 to 85 band. So doesn't matter what your yield is, price is 417, you're getting 100% indemnity. Now the producer, right, producing right as APH, we had a what? 462 to 417. That'd be almost a 50-cent drop, just like the last 3 years on corn. But he produced right as APH. Well, his revenue is $834. His RP wouldn't pay him a dollar. And he's, let's see, $50 away from netting a dollar before premium. And the premium is probably $25. So you're talking $75, which is probably the equivalent of almost 17, 18 bushel before you're netting a dollar on the RP insurance, where the clip maxes out. So that's where the clip is a better option. So yeah, I included some, price charts from the last year. We have soybeans November 26 here. You can see the price action. I mean, we had lows throughout last summer. We never really had a chance. We've had some gains here, December going into the early part of March. Um, Basically, we have about a buck and a half to $2 range in that year's time frame. So between right now and the end of July, we have 4 months, right? We're hopefully, I'm hoping we have a chance to see, mid 11s to low 12s on beans. And I think with clip, at some point we could lock in over $12 on the beans this summer. I mean, what I'm shooting for on my clip purchases this year is I'd like to be over $12 on beans, and I'd like to be around that 5 to 5.25 on corn. That's where I would look at really buying this policy and committing some money on it. Because then I know that if it doesn't pay me, I had a great year. That's exactly what I'm thinking about. We have a corn chart here as well. You can see the price action here recently. My goodness. I mean, we've had a 50-cent swing in 2 weeks. We had our, report. The good old government came out with the report, shot the acres and bushels real high, dropped us a quarter. We gained that quarter back, gained a little more, and then shot right back down to about the average. So it's going to be a very volatile year. I think anybody looking at it could tell you it's going to be a volatile year. It's going to be a lot of ups and downs. The next big report, we actually have a WASD coming out at 11 this morning, right? I don't think there's really big expectations on that. The big one I'm looking for is that March 31st planning intentions um, report that's going to give us an estimate on bean acres and corn acres. That's a date circled on your calendar because it'll be a mover. I mean, if they add a lot of bean acres, subtract a lot of bean acres, that'll be a week where we're going to get some pretty good opportunities on one or the other to lock in some higher prices. So that's essentially what Clip is, how it works. I've been working through these um, a lot in the last 3 years. Like I said, we were part of building this policy with Hudson Crop. Um, we really like this program. It's helped a lot of our growers, especially the guys that had to pay high cost of entry to rent a farm. Um, Anybody that's in here, if you want to ask a question in the chat, Silas is in here too. I'd be happy to answer any questions anybody has at this time. Silas, do you got anything in the chat, or is there anybody that wants to inquire about anything we went over?
I am not seeing anything, but like Trevor said, his contact information is right there on the screen, and we'll be sending an email with a link to this video that you can revisit. But feel free to reach out to Trevor directly if anything comes up.
Yeah, and I appreciate you guys. I mean, we're all busy, right? I appreciate you guys taking time to jump on here with this. Like I said, I'm kind of unique in this policy because we were on the ground floor creating this 3 years ago because we met with farmers, we saw a need, we went out and created a policy to meet the need, right? And this is there for anybody that wants it. Um, Feel free. That's my email. That's my cell phone number. Anybody that has questions or wants individual quotes, reach out to me, and I'd absolutely love the opportunity to see if there's anything I can do for you.
Okay. Thanks, guys. Have a good one.
Thanks, everybody.